Now we look into the foreign exchange itself. Now we're here with also seeing that the dollar has actually come off quite a fair bit this past week. There are a few factors why this is the case. First of all, is that sell America trade. Remember, there is the possibility that foreign investors are basically looking to rid themselves of any kind of dollar assets, okay, or basically American assets. So that has also negatively impacted the movements in the dollar. So first, we want to take a look at the dollar index. Now, this is a basket of currency consisting of US major trading partners. We have the euro, we have the sterling, we have the Canadian dollars, we have the Mexican peso, and of course, we have the Japanese yen, which make up this basket, with the majority of the currency taking a bigger weightage has been the euro. Here we can see that the dollar index has been coming out, and on Friday we do see a more aggressive sell-off to 97.425 towards the lower end of the trading range for the week itself. So this shows that there is momentum behind this latest decline in the dollar index, which also means that the other principal currency will actually benefit conversely. Okay, here we take a look at the internal structure here in a 4 hours time frame. You can see that the sell-off on Friday is actually quite aggressive because you can see there's momentum behind it. Immediate target, if you base on the equality move, there's a possibility market may actually challenge anywhere between 96.4 to 96 or even 97. So where the market closed at 97.45, there is still that possibility of further losses ahead in the dollar index. And if you look further down on the daily time frame, my projected target is at 95.5. So even if the market do not hold at 96.4, for example, it may still decay down to 95.5 over the medium term based on the daily outlook here. Okay, so like I said, this is a mirror image of the other principal currency. We have the euro versus the dollar, which is exactly a mirror image of the dollar index. So here we can see the daily time frame we saw on Friday. There was a surge in the euro dollars pricing. Now we knew that somewhere in the third quarter of last year, the high traded in the euro versus the dollar is a 119.19. So now with the market now at 118.26, for example, a re-challenge of this level cannot be ruled out. Okay. In fact, my target all along has been at 119.30 thereabout. So there's this possibility the market may actually challenge this high marginally. And then I want to see what happens after that. Does the market continue to rally, or would it have a negative reaction? So this is based on the daily time frame. In the internal structure here, we do see that this move here has a possibility to extend higher to 118.60 to 119.80. Okay, that will be marginally higher than the high traded last year. So this is the expectation here, the possibility of going all the way to 119.80. Okay, so do look out for the possibility of further gains in the euro versus the dollar. Now, sterling follow a very similar path, but the structure is very, very different. Here we can see the sterling has been moving higher to a high of 136.50 thereabout on Friday. And we can see there's this testing of this nearby resistance line, which is basically an imaginary line that I drew by joining the most recent peaks here. And we can see that the high of 136.45 actually marginally benefited this line. Okay, whether that will result in further gains in the sterling, I think there's every possibility considering the weakness in the dollar going forward. So again, this is the daily time frame. Let's take a look at the internal structure based on 4 hours. Here I have a target about 136.70 to 138.70. Within this price, if the market continue to rally higher, there is a possibility of this market moving another 100 pips higher. Okay, so again, I think the momentum is favoring further gains in the principal currency relative to the dollar. Here we have the Aussie. The Aussie also closed very, very strongly this past week. We have a high of just under 69 cents to the dollar, and this is an all-time high. Not all-time high. This is the highest we have seen since the bottom at 0.55. Okay, so going forward, there is expectation of further gains in the Aussie, especially if gold continue to surge the way it did, because Australian dollar is a commodity currency. It should benefit from a rise in price in commodity prices. So going forward, the immediate target is at 70 cents to the dollar, not that far away from where we are at 69 cents. Okay. Right, here we have the internal structure, here the 4 hours time frame. We can see currently the market is at 69 cents with the possibility of gunning all the way to 70 cents to the dollar. Okay, so upward bias remains very positive, although the overall directional bias is negative. But here we are beginning to, we are still seeing the continued strength, not so much in the strength of all these currency that I just mentioned, including the euro, the sterling, even the Aussie dollars. It is basically the weakness of the dollar that's causing this currency to actually rally higher. Now, as far as the other way of looking at currency, the biggest move this past week has been what happens in dollar versus the yen. So we can see on Friday there was a massive sell-off in the yen, dollar versus the yen. Now, the high traded 2 weeks ago was 159.45. Now, I did mention in previous week's presentation that as the market goes higher to test the 160 levels, FX traders are going to be very nervous about possible intervention by the Bank of Japan. Because when you go back to 2023, there was the dollar yen went to very close to 162 to the dollar. And that was when the Bank of Japan, together with the Ministry of Finance, came in to intervene very aggressively in the FX markets, taking down the dollar yen down more than 3,000 pips over a period of what, 9 weeks. Okay, so market is very leery of any intervention. So this week, this move on Friday does looks and smell like an intervention. But has that been the case? So doesn't matter because technically speaking, we do see momentum behind this pullback in the dollar versus the yen. Okay, so later on we will also be talking about really is that the case whereby the intervention actually took place. Now, for many reports, there was no confirmation there was any intervention by the Bank of Japan. What I do read and from most analyst report is that there were the Bank of Japan tracking rates. Now, before central banks move in to intervene by physically selling the dollar versus the yen, for example, in this case here, there will always be the prelude where the bank will call up commercial banks to check what is the current rate. So FX traders are very sensitive to central banks checking rates because that is always a prelude to an intervention. Okay. Apparently, this time there was no intervention. They were just simply checking rates. But that's enough to unnerve traders to actually unwind the long dollar position. Okay, that resulted in accelerated decline in the dollar versus the yen. And not only that, we also read reports that the Federal Reserve Banks of New York, which is the largest branch of the Federal Reserve, uh, also were checking rates. So it suggests that there is some kind of coordination between the two central banks here, and that has also give credence to the possibility that FX traders were thinking that it's going to be an impending intervention that caused the dollar to come off very aggressively against the yen. Okay, and it is no accident because on Friday we knew that the Japanese government has suspended parliament, not suspended, they dissolved the lower house and call for a snap election. This does not happen in isolation. It could be related because the statement coming out from the Japanese government is that they will be watching for dislocation in the currency markets. Basically, what it means is that if the yen continue to weaken, there is always the possibility of intervention by the central banks. Okay, so that has been keeping FX trader a little bit more nervous than usual. Here, the internal structure, we can see that the sell-off has been very aggressive from 159.22 all the way down to 155.60. That is a big move, covering more than 300 pips in just one trading session. So technically, the market has hit a target. Now, here you notice that I use the 1.618, meaning to say that I do see this as a very aggressive move, which is a very aggressive move, as the price action here revealed. So if the market holds out at 155.60, and does not decline further, there is a possibility we may see a shallow rebound followed by another leg lower. Or the market could accelerate at the get-go tomorrow when the market opens, okay? And it can go down all the way to 153.90. So that would be 2.618, which is another target to look at if the market continue to experience softness, okay? So this is definitely very aggressive looking. So it also tells me that employing such a 2.618 is not unusual. Okay, so there's a possibility the dollar yen may continue to weaken towards 154, and then we'll see whether it can stop there. So near term is still selling dollar. The other currency that has benefited from the weakness in the dollar has been the Swiss franc. You notice that the Swiss franc has actually strengthened to 78 cents to the dollar. So this has been the price movement. So what we see here, the dollar coming off, no, not the Swiss franc coming off, is the the dollar going down against the Swiss franc. So correspondingly, it means the Swiss franc is strengthened. Now it only requires 78 cents in the Swiss franc, 78 something in the Swiss franc to exchange for one US dollar. So it means the Swiss has actually strengthened. Now we all knew that the national bank, the Swiss national bank, do not want or do not desire a strong Swiss franc because the biggest trading partner for them is the EU. If the Swiss franc strengthens too much relative to the euro, it will make their exports to the eurozone that much less competitive. Okay, so they would rather not have a strong currency. But here, what we see here is that people are running to the safety of the Swiss francs. Okay, so that result in the Swiss franc gaining more strength than they wanted. So currently we see that the price here is this is the wrong price. Okay, here is typo error should be 78 rather than 68. Okay, here is where the market is. Okay, here we have the internal structure. Here we have a three-way pullback. Market is getting very, very close to the target. Anywhere between 77 cents to 77.8 cents, or rather, this is not cents, this is called a centime to the dollar, is where my target is. So we are very, very close to this target here. And the question here is, will it be able to stop where the market closes on Friday, which is at 0.7788?